Hi, everyone. I'm Rick Bensignor. Today is Tuesday, June 21st, the first day of summer. And welcome to this week's In the Know Trader show. In our trader education portion, we're going to take a look and discuss why does watching sector performance matter to your overall process about looking at what's going on in the market. And this week, we're going to focus on the industrial sector. So we'll take a look at the XLI ETF and then the XLI against the S&P, as well as a dozen or so, or as many of these as we can get to, of the top names that make up the industrial sector to the S&P, and of course, the large cap portion. Let me tell you a little bit about the products I have. You can find them all at inthenowtrader.com. I have a weekly ETF tactical trader report, comes out generally Thursday evenings. Gives a very good macro view of what's going on in the markets. We'll look at really kind of across the macro landscape. So we'll look at bonds and commodities and the dollar, and do a deep dive into the S&P and the key levels you need to pay attention to. I'll give you a brand new ETF trading idea each week, as well as walk you through every open trade we have until it gets closed out. I also have something called a 7-Eleven report. It's a monthly report, comes out the last day of each month, and its goal is to outperform the S&P by being in no more than 7 of the 11 macro spider ETFs, such as XLK, XLI, XLF, etc. There are 11 of them. So we are in no less than 5 or more than 7 at any given time with the goal of outperforming the S&P. And how are we doing with that? Well, year to date through May 31st, we are outperforming the S&P by 334 basis points. In our fiscal year that starts every August 1st, we're outperforming by just about 4.4%. And since we started in August of 2020, we are outperforming the S&P by 7%. These numbers put us at the top of the game of anyone playing S&P outperformance, which is virtually every mutual fund out there. Anybody that's got a benchmark to the S&P, we are in the top decile of those playing that game. So if you're interested in that, especially if you're a financial advisor or an individual who puts money into spiders, I'd strongly have you consider looking into this 7-Eleven report. Also, I'm going to be most likely starting my own In the Know Trader YouTube channel very shortly. And here is a link that you can use to sign up now for it. So this Stock Charts produced show gets about 1,000 listeners per week. And if you guys sign up now, using this link to sign up for my In the Know Trader YouTube channel, and I get a few hundred people signing up, I will continue doing these through my own YouTube channel. So please take a look at this. It's not something you can click on, but you can see here the link that I've shortened from a much longer link with a bit.ly shortened link. So there it is. Go to it, please, and sign up now. All right. So let's talk about why does watching sector performance matter? And it matters for several reasons. And first and foremost, it shows you where the flows are going at any given time, what sectors are in favor and which ones aren't in favor. So of course you can play the market as a whole. For instance, buying spiders, you're buying the whole S&P. If you can look at which sectors are outperforming the S&P, so for instance, something like XLE energy, which since last year has dramatically beaten the S&P, you may want to have a bigger focus of your portfolio or new ideas going into the sectors that are outperforming. So part of the reason we look at the sectors each week is to give you a sense of where they stand in relation to the S&P. Sometimes we look at it on a year-to-date basis. Sometimes we look at a month-to-date basis. But the goal here is to give you a better sense of where the market's inflows and outflows are so that you can better adjust your portfolio, unless you're a pure buy and hold person who never adjusts or never does anything other than be long the spiders. And look, for long-term investors, if you're in your 20s or 30s, maybe even in your 40s, and you're listening to this, and your 401k, certainly your retirement plan, should be fully invested. And generally, if you're in spiders or Qs, or both of them, maybe even some Russell 2000, the IWM, that's generally the best way to play long-term, multi-decade investing, because it's very hard for the average person to outperform the market. It's very hard for most people who are in the industry to outperform the market. So, statistically, 6 out of 7 portfolio managers can't beat the S&P over time. So being in spiders, Qs, any of the passive indexes are a good way to invest for the long haul. But if you're a little more tactical and are willing to play some of the cyclical moves that occur in the sub indices, these 11 sectors, then by focusing on those with some regularity, you're going to get a better sense of where you want to put your money at any given time, as well as which sectors you want to avoid. So let me jump forward here. And here is, for instance, the sector performance for the month of June. All right, so this is just month to date. And on the far left side, we see that the S&P is down a little over 11% on the month. Obviously, one of the worst months the market has seen in a heck of a long time. And you can see that energy is the worst performing sector this particular month, down 15.7%. That is the first time we've seen underperformance from energy, I think probably, if I had to guess, since maybe last August. It's giving back some of the gains, but is by far and away the best sector to have been in. And looking at this, all 11 sectors are down, but staples are down the least. They're only down about 7.5%, followed by healthcare down, about 8.3. What's interesting to me, and again, part of the reason we look at sector performance, is when I look at this particular month, it's different than most months we've seen this year, because you've got the most amount of sectors close to what the actual S&P is doing than we've seen in a long time. So, the outliers are energy, staples, healthcare, but even materials, utilities, and financials, which are doing worse than the S&P, they're not so far off from what the S&P is doing. And if you look on the left-hand side and you look at consumer discretionary, communication services, technology, and industrials, they're pretty in line with the S&P too. This month probably has the least disparity that we've seen in a long time, which means this is a month that is going to be fairly difficult to outperform the market. And that's also interesting for you to know, as we're now 2/3 of the way through the month, because you're not seeing that big disparity. And other than really energy standing out as the one sector that got decimated this month, and that is, by the way, something we anticipated in the 7-Eleven report, we'd lowered energy exposure by 30% on the first of this month. So I saw this coming. And that's also, again, one of the reasons you might want to subscribe to that, is because we are frequently anticipating very well the moves in the sectors, and that's why we're outperforming the way we are. But looking at this, you'd think for the last 10 days of the month or so, you're going to have a hard time really figuring out where to be sector-wise because they're so close. The performance is so close to what the S&P is doing itself. So, you know, this is a core part of your analysis, should be looking at sector performance, both month to date and year to date, on a fairly consistent basis in order to understand where the flows are going and where, you know, hot money is going into, as well as where money is coming out of, so that you can align yourselves better with what institutions are doing. Okay, let's take a look at some charts. And here, let's start with, actually, let me bring us to XLI. So here is the industrial sector. Most important thing here is the lagging line trying to cling right onto the bottom of the cloud. Any further weakness would suggest that the sector is going to see potentially as much as 10% more downside before we get down to 77 and change, which would be the next level from the propulsion exhaustion level. Overhead resistance going forward is going to be the bottom of the cloud. A few months down from now, the one thing that this sector has going for it that some of the other ones don't, and the S&P doesn't, is just how narrow the cloud gets as we go across the fall into winter, because when it is that narrow, it's much easier to pass through than when it's nice and thick. So we at least know going forward where potential resistance is. And if I were to just draw a horizontal line across where most of the key lows were, we see that a few weeks ago, the high came to just about where we broke down from. So we know there's going to be resistance there up to 98.60 or so. 98.60 becomes the key level going forward. You would have to hurdle through that on multiple Friday closes to take this out of bearish mode. Otherwise, this is still a sell on rally candidate. And look, we could get a strong run here. The S&P's up almost 100 points today. Near term, we certainly can get a bounce, but you know, this still presents itself as a sell on rally candidate. Let's look at industrials against the S&P. And here's the view going back several years. So it does at least have a near-term bottom, but I can just spot, it looks like there's some type of trading channel here. And you can see, you know, again, a week or two ago, we got up to it and we pulled back. You've got to get above that to then potentially go and test what looks like was a prior trading channel. So you know, you have the room on, if this breaks out, it has some room to go before it would start hitting resistance again. But for the time being, this is essentially 1, 2, 3, 4 times up that this has tried to rally and hasn't been able to break through. So this is not one of the sectors that we actually have in the 7-Eleven report just because of this alone. So that's the look there. And now let's get to some individual charts. We're going to start in order of biggest cap name, which is Raytheon. So we'll look at all these as weekly charts. Raytheon has gotten to a 9 out of towards a 13. So that's last week. So here's the good. There's good and bad here. The good is that last week perfected the setup 9 count. Normally we want to see set of 9 counts have bar 8 or 9 as the low of the move, or bar 8 or 9 as the high of the move if the market was rallying. We don't like to see bar 6 and 7 be the low. So until we see a move beneath bar 6 and 7's low, we can't say this is perfected. It did perfect last week. We've got the big gap up this morning. We're moving higher. Initial resistance is going to be at the conversion line. From the weekly chart, secondary would be the middle Bollinger Band. Third would be up here at 338 or so, where the cloud's baseline is. So for now, we may get, again, a trading bounce, but hard to say that we have a definitive bottom in place, simply because the count's unfinished. The S&P has bounced from its lagging line, hitting the bottom of the cloud, and so it's looking, you know, better. Industrials is weaker than the S&P. just basis this picture, because this has come out through the bottom, and we need to look at standard resistance levels for where this rally may run out of steam. Let me put up propulsion here. So the key level on the upside would be 330 and change. Right now, you would have to hurdle that on multiple Friday closes to essentially take away the bearish component that we've seen. Doesn't mean we can't run into problems up higher, but RTX needs to get above that to kind of change this whole bearish outlook and not selling into rallies. UNP would be next. So Union Pacific Railroad is, you can see, technically stronger in the sense that the lagging line is still in its cloud. You already have a perfected set of 9 count. It has traded lower than that. You're getting the bounce. You can see resistance going to be, this week and next week up against the conversion line and the bottom of the cloud. And then there are targets up here. You would have to get way above 247 to change this picture. However, because the lagging line hasn't come out through the bottom of its cloud, not only this is still considered within the context of the much bigger, longer term structural bull. You've lost a lot of the bull move, but you have not gone into bearish mode. So this, just comparing, let's say, Union Pacific against Raytheon, and of course they're different animals, all within industrials, but very different animals. This is the stronger name. Let's take a look at UPS. Similar in the sense you have the chance here for a double bottom. No set of 9 count down. You've got your cloud going forward that should be strong resistance. This needs to get above 203 and change to really change the bearish picture that we've had this year. But in the scheme of things, this is still in bullish mode off of the 2020 low. Honeywell, another kind of defensive contractor. Double top, or triple top, even against all-time highs. 2 of them came with 13s. This has now broken through, prices broken through months ago. In fact, the whole year we've been beneath the cloud. The lagging line has now broken through. If we get multiple closes, weekly closes under 174.5 or so, that's a bad sign. So trading bounce up here, look for resistance, I'd say right here between the middle Bollinger Band and the conversion line would be your first level resistance. This one's, in more trouble than some of the other names we looked at. Caterpillar, this is something we've rarely seen. This actually has a 13 for a downside exhaustion signal. Got a real nice bounce all the way up to the top of its weekly Bollinger Band. Has come back down. You want to see this kind of hold above 188-ish. Multiple closes underneath that would suggest lower prices. This is still hanging on here, and so far we'll see if any other ones show up, but the only name that I've actually seen in a long time that's got a weekly 13. And this has gone really sideways since last, this is a whole year of sideways price action, basically traveling back and forth between the high and low Bollinger Bands, which makes sense when they're flat, because 95% of all price action is going to do that just based on how Bollinger Bands are constructed. But the fact that this has a 13 gives me something to lean on as far as the bullish side. Lockheed Martin, another defense contractor, very different looking chart. So here is what used to be, hold on, that's not the line I want to draw. Let's put up a trend line. So before COVID, that was this line I just drew, was the all-time high. We got above it, but we're back beneath it. So that's not necessarily good. You can look at that as potentially long-term double top. It is holding, well, this week because of the rally, it's holding the base. More importantly is we got close to the propulsion exhaustion level and the bottom Bollinger Band over the last couple of weeks. We still could play with that. You don't want to see it coming out through the bottom end. That would suggest another leg down, and resistance here is going to be a little harder to find, but I'll put it kind of right near this middle Bollinger Band, which is also where the bullish propulsion level up of 434.7 is. So otherwise, right in here, you're kind of in no man's land. If you're long the name, it's probably a hold. I don't really want to see new lows coming on this one. Deere, more of an agricultural name now, has had a couple of Friday closes beneath the bottom of its cloud. Notice the lagging line is still well within its cloud. This is kind of mostly sideways. If you look, we're still holding on to support. This is a name I think you can consider, especially if you still think commodities have some room to go. Then this is a name that is agriculturally related, and it is I guess, well, just fair to say, a name to consider. New lows here don't necessarily break this. What you don't want to see is the lagging line coming through the bottom. I mean, count-wise, we're nowhere. So there's no downside exhaustion at all. So for right now, I'd say from a trading point of view, I give the edge to the bulls, and I'd lean that way. Boeing got a good snapback over the last couple of weeks. So setup 9, notice the 9 count when it came was imperfect because bar 8 and 9 wasn't the low of the move. We've made a new low now last week to take out the low of 6 and 7, and now bounce back, but you're going to start running into resistance here. This needs to get above 160-ish on multiple Friday closes to help improve the chances that you're turning the corner on this name. Tough call, because on the downside, you could run down to 100-ish or so before finding its true bottom. Tough name. I'm not sure I play this just because it's not so clear. 3M, one of the weaker names, trading beneath its propulsion exhaustion level. Nothing count-wise here. The only thing you've got is the lows from COVID, which was made on a 9 count. You're only on a 4 count here. So definitely one of the weaker names in the group. Probably one I tend to avoid compared to other names that we've looked at. GE, also on a 4 count, nothing here with exhaustion. Triple top against the highs, the last one coming with an exhaustive 13 signal. The move into the cloud, through the cloud, the lagging line through the cloud, nothing good here. Downside targets are all the way close to $50. Don't know if it's going there, but it's just not a name that looks particularly appealing at all. And it's also a name that you'll see is barely above Friday's close with the market up 100. So this is really not partaking at all in today's rally. And my guess is GE against the market is not doing particularly well, and it's certainly not doing well against industrial. So not a name I have any interest in. Northrop Grumman, this is definitely one of the best charts we've seen. It's gone nowhere for months, but it's still near all-time highs, and it's much better. It's well above its cloud. It's holding its middle Bollinger Band. This is one of the premier names that we've looked at today. Look for support if it pulls back near 430. Resistance now at about 474 or so. So if this Friday closes above 455, and then next week we make a higher high than this week and we close up on the week, that would confirm this propulsion bullish signal and target that 474 level. So definitely the best name we've seen in the group so far is Northrop. Let's look, let's go back to a railroad, CSX Corp. Trying to hold on here. We're on a 7 towards a 9, lagging line just holding above the bottom of its cloud. So support, the thing is the target moves down here at 27 and change and 26 and change. However, getting there also implies that the lagging lines come out through the bottom of the cloud. Tougher one, but at least for now, still structurally holding on to its last remnants of the bull move off of the COVID lows. Look for resistance, multiple shorter term resistance levels first, but the key level is going to be up near 34.5 or so. FedEx. Here is another one with a 13 count that came, in April, and it's moved up, and we reached the top Bollinger Band last week. We're pulling back, so this is pretty flat. Also, not getting much on today's rally. It's already seen, a build up. So we've hit some resistance more against the bottom of the cloud here, which happens to be unrelatedly right around 250, which is the same level that the bullish propulsion level is. So tough, right in here, tough call on how to play this. Waste management bouncing off of the bottom of its cloud. It's an 8 count now. We would have to trade lower than last week's low to perfect. You'd still get some support against cloud in here. So this is possibly on further weakness, still a buy, but this is going to be range trading if you want to play towards the lower part of the range. And then the last one we're going to do is Norfolk Southern. Norfolk Southern. And this has broken through the cloud, already has a perfected 9. And I guess what you've got here is just kind of what was prior breakout area. Let's see. Yeah. So you could do a little nibbling against here, but you want to stop yourself out a little beneath there because otherwise it falls down and it's got plenty of room to go. So this needs to hold right in here. That's it for this week. I hope you enjoyed the show. Again, please go sign up for the new In the Know Trader YouTube channel. And I'm Rick Bensignor. Talk to you next week.